If you had invested $10,000 in Amazon 5 years ago, it'd be worth about $15,000 today. Not bad, until you compare it to its competitors. That same $10,000 in Google would have turned into more than $35,000. Microsoft would be up by 120%, and even Walmart has more than doubled Amazon's performance. Amazon has actually been one of the biggest underperformers in this group. This isn't the first time this has happened. Back between 2011 and 2015, Amazon also lagged behind Google, Microsoft, and Walmart for several years. Investors assumed the growth story was fading, but then the exact opposite happened. From 2015 to 2018, Amazon went on a melt-up, rising more than 500% while those same competitors lagged behind. Today, we're right back in a similar setup. Some investors believe Amazon's momentum is gone. Others, including billionaire George Soros, who just bought roughly $500 million worth of this stock, believe another turn is coming. It'll most likely come down to one part of Amazon's business that most people overlook. Like most stocks, when a company's share price underperforms, it usually reflects concerns about its underlying business. And for Amazon, those concerns center around two key areas. The first is its core e-commerce segment, which still makes up more than half of total revenue. Many investors worry that ongoing tariffs and trade tensions could squeeze margins in this business. That concern isn't unfounded. A large portion of Amazon's marketplace, including products sold by third-party merchants, relies heavily on imported goods. If import costs rise, Amazon could absorb those costs, which would directly hurt its profitability. It's a problem that companies like Google or Microsoft simply don't have to deal with. However, if we look past the headlines, the numbers tell a different story. Amazon's profit margins are now the highest they've been since 2006, showing that the company isn't being squeezed the way headlines suggest. And that tells us that they've managed to offset the impact of tariffs, perhaps by passing some costs to consumers while at the same time improving its operational efficiency. But that's not the only reason investors have been cautious. The bigger concern lies in Amazon Web Services, or AWS, its cloud computing division. Over the past decade, AWS revenue has surged from around $2 billion a quarter to more than $30 billion today. It's been Amazon's fastest growing division, and it holds a dominant position in the industry, but competition is catching up. This chart shows AWS sales growth since 2023, and as we can see, it's still healthy at around 20% per year. However, when we compare that to rivals like Microsoft Azure and Google Cloud, their growth rates are faster at around 30%. That growth gap has made some investors nervous, wondering if AWS's dominance is starting to erode. And that matters, because even though AWS represents only about 18% of Amazon's total revenue, it accounts for roughly 60% of its total profits thanks to its high margins. So any slowdown here could have an outsized impact on its profit and ultimately investors' sentiment. But context also matters here. As this chart shows, although the growth rate is slower, AWS still generates the largest cloud service revenue in the world. At roughly $30 billion, it's nearly as large as Microsoft Azure and Google Cloud's sales combined. At that scale, slower growth is natural. Smaller competitors are simply catching up from a smaller base. So the data suggests Amazon's leadership in cloud computing is still intact, and some analysts think it may even strengthen over time, because the global cloud services market is expected to triple over the next decade, from around $700 billion today to more than $2.7 trillion by 2034. The reason behind this growth comes down to AI. Every large language model and AI assistant runs on massive cloud infrastructure. The more AI is adopted, the more computing power and cloud storage the world needs. So even as competition grows, the entire market size is expanding rapidly, meaning more pie for everyone. And given its dominance in this space, many analysts believe Amazon is well positioned to capture a major share of that growth. OpenAI, for example, recently signed a $38 billion deal for Amazon to train its AI models, with plans to expand the capacity over the coming years. To keep up with this rising demand, Amazon has been investing heavily. This year, it's on pace to spend over $100 billion in capital expenditure, the highest in its history, and about double what it spent before ChatGPT came out. Most of that money goes into data center expansion, AI infrastructure, and hardware to improve AWS competitiveness. If these investments pay off, it could mark the start of another major growth phase for AWS, and history shows what that can mean for the stock. Between 2014 and 2020, AWS sales grew nearly tenfold, and during that same stretch, Amazon's share price soared about 900%. If AWS growth re-accelerates from here, it could once again be the catalyst behind Amazon's next big rally. But of course, it's not risk-free. One important thing to watch for is AI adoption. If AI adoption slows, or if businesses begin to tighten their cloud budgets, that could temporarily cap demand for new infrastructure, and in turn, slows AWS growth. Given how much Amazon is investing up front, any slowdown in returns could keep investors cautious. At Capital.com, we'll continue tracking the latest price performance and business fundamentals of market leaders like Amazon. Hit like and subscribe to stay tuned. Thanks for watching.